The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stock Tech. My name is Gaurav Sodhi. Joining me today is analyst James Carla. Welcome, James.
Good morning.
We're also joined by analyst Alex Hughes. G'day, Alex.
G'day, Gaurav. G'day, James.
G'day.
So, gents, Alex, you've got a little baby in the house. How are you doing with a little with a new little pet?
I am working through it. It's been a huge change working from home. There's a few new noises to contend with. But yeah, for the most part, getting through it.
And you got nothing. If you had complained about it, I would have been very upset because this is the easiest part. Those first couple of months, they don't do very much.
No, the easiest part is when they get into double figures and start loading the dishwasher.
I'm a long way from that.
Yeah.
I do have my 5-year-old on all sorts of house duties. I bought him new gloves for outside work. He was complaining the other day that the sticks had made him pick up were too sharp. Yeah, and that made him hop and do it on one leg while he picked the sticks up. So I got the drill sergeant going really well.
Good work.
Yes, that's right. So let it be known, if any of you mess up, it's going to be one leg and sharp sticks for everyone all around.
Yeah.
Yes.
If
Now,
my teenagers misbehave, I'll send them over.
Oh yeah, do that as well. Could use the
After
help.
the
Garden's a
lockdown.
mess. Maybe the baby's a bit too young, Alex. Might keep that one with you.
Yep. I think I can save that for future years.
Nice one. Yeah, good. Right, gents, we're getting towards. I've heard it said that we're now towards the end of the isolation period. Officially, a few restrictions have eased.
The first isolation period.
Oh yeah, good
The
point.
initial isolation period.
That's right.
And possibly the only. Who knows?
Well, yes, but we'll get to that. But the market is now up quite a bit. It looks as though investors have responded to a virus outcome that's probably the best that could have been predicted for Australia. By some measures, we're actually in bull market territory already. But what happens now? JC, maybe we can start with you. We've still got a very lengthy buy list. It seems to me there's still a healthy amount of opportunities on the market, even though prices have bounced off their lows. Is this a period where we should still be allocating money, or are you doing what most people I talk to are doing and just sitting and waiting for a second down leg?
Well, I'm pretty much all in now, to be honest. So I'm just waiting. If I had more cash, then I might do some more buying. But I'm pretty very much, I'm swapping one for something else. At the moment, if something gets crucially, if I'm desperate to buy something, I've got to sell something really. But I think that the thing that I noticed about your introduction there is that when you said that I can't remember how you put it, but I think that this is going to be a long road, and we're only a few steps down it. I think that's people seem to be thinking, and the market maybe is even discounting that we've kind of got through this and we're coming out the other end. But we still don't even know if we're going to get a vaccine. And at the moment, there's no immunity in the country. There's a few cases. We're coming up to winter. We've been very fortunate, or we've done very well, or a combination of both, to get where we are. The health service hasn't been overwhelmed as it has in other places and all that. So, it's good so far, but so far, like I say, is I think only a few steps down the road. So, I think people need to be aware that while they're sort of lifting a few restrictions, like open house inspections and auctions of properties and stuff like that, public auctions, in New South Wales anyway. A few other restrictions obviously being lifted. I think people got to have in mind that there are great risks that the thing could start transmitting again more widely.
Do you agree that it seems to me that the market has been much more selective about what it deserves recovery and what deserves to be kept down? It seems those heavily hit areas are still very low. So Flight Centre and Webjet and all of that, they're still relatively cheap. looking at
I
this
think
mortgage?
that's highly rational. I think that's
Yeah,
I was actually, I mean, I was thinking about this because one of our things is thinking aloud, and I was thinking about that as maybe being a thinking aloud for later because, um, it's very easy to think in terms of, oh, look, this could still be very bad, so the whole market shouldn't be
that's right.
bouncing,
Yeah,
and to think in terms of the whole market doing this and the whole market doing that. But this is a very unusual situation. This is not like a big depression at this stage anyway. There are certain stocks, the zeros of this world, which really shouldn't be greatly affected, you would think. A lot of the tech online, the Googles, a lot of stocks, Zoom's doubled. There are a lot of stocks which are actually not in such a terrible place, but then there are the travel stocks and some of the specialist retailers who, this is life or death.
yeah.
There really is a very, very wide range of outcomes for individual stocks, and it's entirely appropriate that some have barely budged and some are on their knees. Yeah.
Yeah, yeah. Alex, how about you? You've perhaps been a bit more cautious, I suppose, than JC has over the course of this. Has the bounce been for you something worrying, something rational? Is this a time to continue feeding money, or are you waiting?
I guess I'd agree with James's assessment. I think it's a case by case basis. So some stocks have done very well in terms of recovery, and some haven't, and that just really depends on their situation. I would agree that cautious is still my approach. I think the government support has helped many businesses, and I think I'm not sure how long that will last for. And I think at some point, many businesses are going to have to start to stand on their own 2 feet again, and that could increase another wave of capital raisings and things like that. And so that's certainly on my mind. I think um, I'm not sort of I haven't done much in the last month or since we last talked. I've really just been assessing new businesses, trying to build my knowledge, and just watching from the sidelines. And it would take me to get high conviction in a new name or an existing name to put money to work. And I've found that I've struggled to find obvious things to do. So my activity has certainly slowed down since we last talked.
It certainly seems to be the consensus that it's a long road, and we're at the beginning of it, and recovery is going to be difficult. But I put it to you, and actually, I add, by the way, that I think that's a very rational expectation. Um, I'm not probably not quite there myself. I'm probably a bit more optimistic than others. And I bring to your attention, gentlemen, some of the retail data that's been coming out. It's been quite extraordinary. So, almost any retailer with an online presence is recording pretty healthy sales. JB Hi-Fi's numbers yesterday were pretty astounding. I mean, I was genuinely quite surprised by them. And yes, I know there's this tailwind of everyone working from home and going out and buying equipment, but you can match that with Adair's, with what's that? A Temple and Webster, the website that sells furniture. Any retail, anything with retail online is doing extremely well.
Well,
Makes me think
yeah,
that maybe it's not people aren't that worried that they're closing their wallets. They're just changing the way they buy things, and that actually should speak quite well to how people are getting through this and how they're feeling. They're still confident enough to spend money.
yeah. I mean, I think people are spending money on. People are still living, and we still need bits and bobs. I mean, we still need towels and home furnishings, and I think people are taking the opportunity to maybe do a bit of work in their house and buying a bit of new furniture and online. I reckon IKEA is probably doing quite well. So we're still spending some money, but there are sections of the economy that are just shut down, and
Mm.
that's, I think, the problem. I mean, no one's going to concerts. They
Yeah,
look a long way off. No one's going to sporting events, and all these things contribute to the travel, to the
yeah.
the food, whatever. When you get there, restaurants and pubs are still closed. The tourism is a massive thing. So there are, I think, look, if you're in the right area and you're supplying things that people still need for their daily lives in their homes, then you probably be fine. I mean, the supermarket's the most obvious example. Um,
I actually think about flipping that around. I think most people are probably going to come out of this in survivable shape, except I would say the people who are really going to struggle. It's a targeted subset of the economy that's going to really struggle, and most of the economy would probably come out of this surviving. It's not not too bad. Not even probably recessionary is my guess. Just looking at some of these numbers coming out, they're pretty good. Even the property market. I mean, Domain's update suggested that things are reasonably good, and property analysts are getting a bit more, or a bit less bearish about how the market might turn out in all this. The banks are still pretty cautious, but you'd probably want them to be, given what their business is. And a company like Tyro, which actually monitors SME business transactions, they're providing weekly transaction summaries, and those summaries are way better than I would have thought. And that's showing that people are still spending money. Alex, what are your
Yeah,
thoughts?
yeah. I mean, well, in Tyro's case, I think the transactional volumes are only down about 40% or so, which is quite amazing given the categories that they actually
Agreed.
service.
Yeah,
You
and
know,
retail is a key category for them, and they're talking about credit card transactions through retail. I thought that would have been way down, and it's just not.
yeah, that's right. Yeah, hospitality as well is another big one for Tyro. Yeah, I think. I mean, I agree with most of what you said. I think everything happens at the margin, so the majority of people still have a job, and they're going to spend money on certain things, and that may have shifted to the things that are in front of them at the moment. So fixing their house and improving their living situation at the present time. But there are people that are really affected by this, and so their spending is going to fall, and that's going to have flow-on effects. So yeah, I think it's just really hard to generalize as it normally is. So you just really need to drill down into that business and what the drivers are for that business, and just try to understand that.
Just speaking,
Sorry,
Alex,
go
go
ahead.
ahead. Speaking anecdotally to lots of people that I know, and admittedly, most people I know are in professions, so they're lawyers, accountants, uh, doctors, and finance people. So people who can, who probably won't lose their jobs over this. But almost everyone I know personally is actually their balance sheet's actually improving because they're just not spending money. Um, and well, for me, but I mean, childcare was my biggest expense, and that's no longer an expense. I mean, yeah, there's a huge subset of the economy that's really struggling. That hospitality sector, um, that's going to be difficult. And as James said, the entertainment area, that's going to be really difficult. But other parts of the economy are actually improving household balance sheets. Savings and is probably up. I think there's a risk here that people just get too pessimistic, and they extrapolate poorly performing sectors throughout the rest of the economy.
Yeah,
JC?
but well, yeah. I mean, I think some of that is true, but as Alex says, it's at the margins. You only need, a really bad recession just looks like a few percent off GDP on an annualized basis, doesn't it? And I mean, look, we're a lot more than that at the moment, of course, but there's going to be a sudden bounce back. But how much of GDP we lose sort of for a year or two is another question. And it only needs to be a few percent for it to be quite an ugly situation.
Mm.
And then you've got, I mean, look, because it just affects confidence and all those things. And um, just sorry, hold on, I forgot my other thread. You've also got to think about how much money the government is spending to support the economy, and at the moment we're seeing a lot of that money come in, and so
Mm.
maybe that's affecting retail sales.
Mm.
But that money, it doesn't just come from a money tree. That's going to have to be
Hang on, are you
uh,
saying there's no such thing as a money tree?
yeah, I'm afraid. Well,
Oh
actually,
no.
I don't know. As long as there's the inflation tree. I mean, so if the government ends up spending too much money, it can
Mm.
always inflate it away down the
Mm.
track. But that's not an ideal solution either. So look, I think that at the moment, yeah, I'd be cautious about those things. I think that look, we've only been locked down for a couple of months. If this is all it is, then that's fine. But my concern is that we're coming into winter, and if we see more cases, and if we have to lock down again, then it could be many months.
Yeah, I just
And
want to
and
jump
that
on. Oh, sorry, James.
no,
Just
again,
that assumption that governments can create inflation. I mean, I don't want to turn this into a macro discussion, but I think that's a lot harder for governments to do than we probably give credit for.
Mm.
Look at the economies around the world where they've died for, where they've really wanted to have inflation, and they just haven't been able to ignite it.
well, but they haven't wanted it that much, have they? I mean, Ben Bernanke talked about his helicopter, and I haven't seen any big money helicopters flying around. I mean ultimately governments, except for in Europe, they can print their own money, so they can just print a whole heap more of it, and then it really will inflate, So I think, well, that's my understanding of economics.
Yeah. No,
It's not my strong suit, probably.
All right, let's bring this back to business a little bit. Alex, I've got a question for you. Something I think is quite difficult right now is how to capture a very large but short-term change in valuations. So a lot of businesses, I'm thinking the ones that I've been looking at are things like the casinos or hotel groups. They're going to get zero or close to zero revenue for maybe 12 months, maybe more than that. But they're long-lived assets that have decades of cash flow. Now, in a discounted cash flow model, you'd probably say that the first couple of years don't add very much to the total valuation, but they do impact the share price a lot. How would you think about short-term, very large changes in revenue and capturing that in valuation? Is that an opportunity, or is that scary the way most people tell us it is?
No, I think that can be a huge source of opportunity. I try to break it down into two parts. The first part is the solvency question. Can this business actually survive to the other side, to the point where they have revenue and profits again? And so that's the sort of the phase that we're at now, where businesses are addressing that either by getting new debt facilities or extending the existing facilities they have, or by raising equity capital from investors. So once you pass that question, then you get to the valuation question, and that requires an assumption about how long it'll take for revenue to recover, and ultimately how much money will they make, and how much money will the company make, and when will the company make it. So that's the
Do
sort
those
of thing.
questions matter? Do you really try and figure out when revenue will return, or do you just sort of? I mean, what I did with so I own Auckland airports, for example, and I don't know when revenue will resume, but I know that it's a long-lived asset, and the capital raise has really helped the balance sheet, and all that, and so I was happy closing my eyes and buying a little bit.
I think you can do that in a panic, but I don't think you can
Yeah,
do that now.
right.
I think you need to understand a range of scenarios that could play out and how that would influence the valuation. So you're not necessarily trying to pinpoint anything, but you need to understand what the situation looks like if it takes 3 years, for instance, for
Hmm.
traffic to get back to some resemblance of normality.
But for
Jake,
something like Auckland Airport, I think trying to answer that question when revenue is going to start again, that's a solvency question, not a valuation question. Because if it's 6 months or a year, 2 years, or 3 years, has big implications to whether it needs to raise money, and
hmm.
I guess that feeds through into the valuation. But the I suppose that the enterprise value of the asset um, isn't really sensitive, as you just said, to the early years of cash flow. The provisos I'd make to that is that it depends a bit on your interest rate, so the discount rate you use. So when you plugging a 10% discount rate into your model, then the early years are relatively more important. Right now, with interest rates as low as they are and long-term interest rates as low as they are, these models, the value of future cash flows is much greater relative
Yeah.
to the next year or two. And the other thing is the growth of growing companies where you think that the future cash flow is going to be much larger than this year or next year anyway. Obviously, 10 years from now matters much more in your valuation. So, which is another reason why a lot of these tech companies, which are growing quickly, things like Altiums and Zeros, have actually held up much better because the next year or two really matters not a lot for them, especially with interest rates where they are, and that's probably a little bit where Auckland Airport finds itself, isn't it? I mean,
Hmm.
with its development potential. And with long-term growth in air traffic, you'd expect reasonable growth from it over the years. So the next year or two doesn't matter too greatly for valuation, except for the fact that if it has to raise capital, and so far it's been able to raise it reasonably, not too dilutive. The threat is that you suddenly have to raise dilutive capital.
Hmm. So, I mean, you've had to deal with this exercise yourself, JC, with something like WebJet, which is at the coalface of all these troubles. Have you? I know intellectually that's that's all correct. But emotionally, it's quite hard to buy into a stock where you know the revenue profile is going to be close to zero for as a period of time. How do you?
Well, I don't think it's hard at all. I think well, you have to make a judgment. I mean, with Webjet, it needs to start making proper EBITDA. By proper, I mean something resembling the past by the June quarter next year. In order to meet, because it hasn't, well, unless it gets another covenant waiver for June next year.
Hmm.
So you've got to decide whether people are going to be going to hotels really by then. Well, that's for the web business. For the web jet business, you want people to be making, international travel essentially. But that's a solvency question, So you sort of make a judgment about that. But in terms of the valuation, with a business like that, I'm just trying to think. I think you've just got to, where you've got these sort of short-term, massively profound short-term events, you've got to take yourself a few years forward, think what's going to happen. So with the first sort of clean year, I'm hoping is going to be the sort of 22 year. And so you take yourself forward to 2022 and think what sort of money it can earn and what growth profile it might have from then on. And that's your valuation. And then you've got to just try to decide what are the odds of actually getting there. And so that you then feed that into a sort of probabilistic weighted expectation.
I
So
don't
if you
know.
if you think there's a half a chance that the company goes bust, then you perhaps knock half off your valuation.
I think my method of closing my eyes and just buying is easier.
Well, back quality. If you back quality
Yeah.
and buy companies that don't have any of these issues, then you don't have to worry about it so much. But if you're buying companies that are threatened with solvency, then I think it's probably quite a good idea to have some sort of idea of the probabilities around that.
Yeah.
Alex, have you found that hard, that the psychology of buying something that you know is going to have sort of zero revenue for a period of time versus your rational mind telling you that it's a valuable asset?
No, I think I'm willing to buy something with zero revenue. I just need conviction in the competitive advantage of the business to do so. Like we talked about Ordinate last time, and that's one where the revenue picture looked, quite challenged in the near term, but the confidence in the competitive advantage allows you to make an investment there. So, um, yeah, I don't struggle with the psychology aspect with that at all. I just find it interesting, like talking about the travel space, though. It's been interesting for me to see the four major players. So there's Flight Centre, Webjet, Corporate Travel, and then Hello World, and how each of them have responded to this crisis. And obviously, Flight Centre and Webjet have already raised capital, and that kind of reflects their working capital positions and some of the fixed costs they have in the business. But some of the other two haven't raised capital, and Hello World to me looks to be in a position where it could actually muddle through without raising capital, and that's due to the fact that it has a franchise model, so that lease liability largely sits with the franchisee, and its balance sheet was just in a better position than Webjet or Flight Centre's was as well. So that's just going back to that case by case basis argument. You could get the same exposure to Webjet in a business like this, but you're potentially doing so with lower capital raising risk in the near term. So I suppose just to add to James's points about how to consider a business like Webjet, there's also the opportunity cost of what else is out there as well. And I think, when you get close to that final decision of making investment, you need to start to consider, is this the best source of my money, or is there actually something else out there that's better and, that would be a more worthy addition to the portfolio.
Does
The other
does
thing,
Hello World not have to support its franchisees? I'm just interested to hear, because if someone's got to be bearing that pain, right? So
Well, I
if
think it's the taxpayer at this point. It's been this fascinating situation.
I see, because they're all getting sort of furlough support, are they? Or
Yeah, that's right. So the job seeker payments and things like that. So I think they've asked for rent reductions or rent holidays from
okay,
the
but that
landlord.
doesn't last. That doesn't last forever, though, does it? So that's what you said earlier on. That's going to roll off at some point, and then there are going to be further questions. Yeah.
Yeah, that's right. So I mean, this is what I'm trying to understand in my head is the government has kind of underwritten everything at the moment, and I think that's why we haven't seen as many capital raisings as we probably would have normally. But the government, like, how long is that going to last from the government? And when that starts to roll off, that may be when we see the true economics of everything coming to the fore.
Yeah, interesting.
Yeah,
Is
I think
Hello World down a lot? Is it discounting and raising, do you think?
Yeah, it is. It's fallen. It's fallen 60, 70%, I think.
I think it's interesting how this whole period can also be a source of competitive opportunity as well. I've been pretty impressed with the way Flight Centre very quickly just basically turned around its business model. It's closing a whole lot of stores, and that probably would have taken them years to do, but probably needed to be done. And they're doing that in a very short period of time. And they can use all the available government support to speed that up a little bit. And Alex, do you think that actually that pivot that Flight Centre is making, does that make businesses like corporate travel more threatened? My guess is Flight Centre is going to have to focus more on that corporate market, and it's going to have to compete more head on with corporate travel. I mean, that's just one example, but the competitive positions of lots of different businesses are going to change. And you did mention before that you're trying to assess these positions. It seems a very difficult task. How are you approaching that?
Yeah, it really is. I find Flight Centre very difficult at the moment because I think you've got the coronavirus impacts, which is hugely challenging to understand to start with. But then you've also got some sort of long-term structural questions. You've got this huge bricks and mortar network, and that involves lots of leases. And I think ultimately they want to get out of that, and it's good to see them using this opportunity to do that in part. But what that business actually looks like in 5 to 10 years' time, I really struggle with. So that makes Flight Centre difficult for me. But so I tend to, that's probably what led me more to Webjet, because I believe in the online channels more so than the physical channels. And I think they've got, with their bed banking business, they've got better long-term potential there. But I mean, how that relates to the corporate travel side, with corporate travel management, I'm not entirely clear on that. I mean, there's lots of competitors entering that space. There's businesses like Serco that are also providing solutions, and there was Booking Holdings recently invested in them, which shows that the big platforms are also interested in getting into the corporate travel space as well. So yeah, I'm unsure is the answer to your question.
It's definitely getting harder, isn't it? That actually brings us onto a useful point, I think. JC, coming out of this, there's going to be lots of behaviors that permanently change, and we've kind of talked about some of these before. What do you think? What's at the front of your mind, JC, about some of the things that are going to be completely different, that might permanently change, and how do they impact your investments?
Well, I'm not a one for permanent change, really. I don't believe in too much of that. We're pretty habitual sort of animals. I don't think.
Hmm.
Look, I think first of all, there's a big distinction here between if we get a vaccine that's effective,
Yeah.
or if we don't get a vaccine, or perhaps in the middle we get a sort of vaccine that sort of works for a bit. Well, I suppose if it works for a bit and we get to take it every year, then that's not too bad. But look, if we get a vaccine, then the whole thing just disappears and everything's fine. If we can't get a vaccine, or an effective treatment, I mean, an effective treatment's a long way behind a vaccine in terms of dealing with this. If we don't get a vaccine, then look, we've got to live with it, and living with it just, I think it's more likely to result in people's expectations of life expectancy being reduced, rather than people. I mean, you got to decide. Is society as a whole going to prefer to have 10 years knocked off life expectancies, or never to go to a Boxing Day test again? And I think people would accept the slightly shorter life expectancy. Ultimately, people aren't going to stop going to concerts and going to gyms and cinemas, and people, because, well, apart from the fact that up below the age of 60 at this point, it looks like I say 60 because I'm in my 50s. below, below the age of 50, anyway. Yeah, you're not a great deal of risk for this. So I think most people are just going to carry on
Oh,
as
interesting.
normal, going to pubs and things, and that's even without a vaccine. If you get a vaccine, the whole thing's just you forget about it. I'm in a year or
Let
two.
me challenge that a little bit, JC. So cinemas, for example, I think are a really interesting point. I love cinema. I would always choose to go to a cinema over watching it on my piddly screen. But there's been a few movie releases over the course of the shutdowns, and some of them have been enormous successes. There was one kids film released. I was reading that it made about $150 million just through downloads, streaming downloads. That's the equivalent of a pretty decent box office open without any of the cost of doing that. That surely must threaten the cinema model. A lot of movies may choose to just open direct to streaming rather than going through the whole cinema channel.
Well, yeah, I suppose that's right. So if it's supply driven rather than demand, I mean,
I see.
well,
Yeah, yeah.
well, look, if that's where they make the most money, I suppose is the point. But look, people, that was already the case 6 months ago that you could stream a movie. I suppose you had to wait a few months for it to be out on at home before you watched it. But you go to the cinema, you get a bigger screen than I've got in my house anyway, and you get
I find that hard to believe.
and and better sound quality as well. And and apart from the person eating the popcorn next to you, you get a better, the sound is
Or the
so.
person puffing a Cuban next to you.
Yeah, well, so look, I think the cinema experience is something else,
I guess my
and
point really was that there's a lot of businesses that are just trying things during the lockdown that they would not have experimented with. So
but they've got no choice. I mean, they've
yeah,
got no choice.
but
I mean,
that's and once they've tried them, they can evaluate the success, and that might very quickly change old ways of doing things. I put cinemas in that category. I'm also going to throw out gyms. Like I wonder whether gyms are going to come back the way they were.
but I think you've got to go. It's not just the individual thing though. It's not just is this, but can I exercise at home or do I have to go to a gym? Um, it's a social aspect as well. People want to go where there are other people. People, cinema too. You can sit at home and watch a movie, or you can go somewhere where there's a bit of a buzz and there's
Hmm.
people around and you interact with a couple of people and you get stroppy with the person with the popcorn. And there's people like to have that interaction. I can't see humans stopping that on pretty much. I mean, look, if this thing was killing 20% of people, from children upwards, then we'd all be locked up forever. I mean, but I mean, I think as it stands, the people aren't going to change habits, I don't think, long term.
Yeah,
Alex?
I think that's right. I mean, there's a reason why gyms' walls are lined with mirrors. People that go to gyms, in part, they like to showboat. They like to show off their muscles to other people. There are secondary motives which drives people to do things. So,
Alex, is your lounge room filled with mirrors as well?
no, it's not. And I don't go to gyms.
Not yet, anyway.
But yeah, I mean, I agree with James on that. I mean, think of, say, like a fancy hotel. There might be a doorman there, and the primary motive for a doorman might be to help you with your bags, but the sort of the secondary motive might be to signal to people that this is a fancy hotel, and that's why the hotel pays for that doorman. Um, I think there's a series of things which go into why people do things, and so I think socializing is a huge element, and I think many of us are just hanging out to get back to doing things with other people. And so all of these sort of stargazing comments about how much the world is going to change, I'm quite skeptical of, because I think for the most part things are going to return to how they were once, if, assuming we get back to normal fairly quickly. And I think where things do change, though, I mean, you see some businesses have their customer acquisition costs fall dramatically as a result of coronavirus.
Mhm.
When we've all been forced to find new ways of doing things, that might create all this free traffic to a business. Think of Jumbo Interactive in Australia as an obvious example. If people can't go to newsagents, they're forced to find an online channel to buy lottery tickets, and so that means Tats and Jumbo are the only two options there. And whether that has a lasting benefit to Jumbo depends on their customer retention. And so I think the real winners out of all of this is when they've got some sort of lock on the customer, or if that proposition is actually just much better than the normal way of doing things. And everyone talks about Zoom. Zoom got all this free traffic, which ordinarily they'd have to market and advertise to get those eyeballs, but all these people have joined, and the true test is going forward is whether they stick around. And so businesses like Zoom that have a network effect are probably going to hang on to lots of users, and they'll be the real winners out of a situation like coronavirus.
See, I hear what you guys are saying, but I must say, I think people are also very habitual, but when you change the habits, they're slow to change back. And I wonder whether offices are going to be as full as they used to be. I think a lot more people are going to be working from home. People have invested in working from home infrastructure. Corporates have set up all these meeting equipments, huge screens, microphones, etc. I'd be surprised if corporate travel even goes back to where it was, a year ago. I think the hotel business is, sorry, the that what's it called? The Airbnb business. I think that is, be surprised. I'm not going to go to stay at some weird person's house anymore.
Well, you might if there was no pandemic. I mean, if there was no COVID and we had a vaccine against COVID and there was no pandemic going
I
on,
see.
you might.
I'm not sure about that. I just think it's raised awareness for me about hygiene and how clean everything is. So I'm not going. So I wash my hands far more now than I ever used to. I don't think I'm going to go back to washing my hands with my old regularity. I'm probably on this new schedule for hand washing.
Well,
And
that's
same.
fine. I'll let you do that.
Mhm.
I, I, look, I hear what you're saying as well. I mean, in terms of home working, I think, I mean, maybe it depends how productive everyone is. I mean, if businesses are looking at productivity and see that there's a big slump, they're going to get people back in the office as soon as they can.
Mm.
I think, look, I think there are trends that the home, online shopping and home working are trends that were already in place, and I think certainly this could give them a bit of a bump. And I suppose that there was probably a bit of a trend towards people watching movies at home rather than going to the cinema because everyone's got much better TVs now and all that sort of thing. Um, but look, there are some trends which will probably accelerate, but I think that wholesale changes to behaviour, I think, are unlikely.
Except Alex getting mirrors in his lounge room.
That would be a wholesale change, all right.
JC, you recently wrote up REA and Domain, which we've talked in the past about REA possibly being, if not the best, and certainly among the best businesses in Australia.
Among, I
Um,
think, is
among,
fair.
okay, I
Yeah.
think I actually had it as the single best business in Australia, but yeah, I think the rest of the team had it among, so we'll keep it that way.
Yeah.
Um, these have been really resilient in past downturns. Is that proving to be the case at the moment?
Hard to say. I mean, we got to wait and see how it plays out. I mean, at the moment they are, I suppose. I mean, um, they when you say resilient in the past, I mean their earnings have kept marching onwards. I mean, I'm thinking of REA particularly, um, but that really is a reflection of the sort of the underlying sort of growth tailwind that they've got. And so if you do get a bit of a downturn, that just moderates a bit. You don't really see them going backwards too much. Um, I think that right now you will see them going backwards. So does that mean they're resilient? They're resilient because, or REA particularly, and this is what I said in the article, is resilient because it's got such a huge margin, so it can lose a fair bit of revenue and still be making positive cash flows. It's also got a strong balance sheet. It's got no working capital, negative working capital to unwind like the travel businesses. So yeah, I mean structurally, it's extremely resilient.
I
Um,
just meant in the sense that it's not really exposed to house prices going up and down. It's really volumes, and volumes should be much more stable than prices. So in that way,
yeah, that's right.
it
Yeah,
should
I
well, it
mean,
shouldn't be as cyclical. You'd think.
no, that's right. So I mean, look, prices affect how many people want to sell their house. But they also affect how much people want to buy a house, I suppose. But I mean, at the moment, we've got this huge fall. They've had to deal with a huge fall in listings, But it's interesting that in New South Wales and WA and Northern Territory, I think they've reopened public auctions and open house inspections. Um, and that just shows, I mean, before we're allowed to do a whole heap of other things, we're allowed to go around and shop for houses. And that
Yeah,
just shows you how much the government is desperate to have a functioning housing market,
yeah.
which I think is sensible. I mean, I think you really need to have that in an economy. So, how long will listings be down? Ultimately, if you've got to sell your house, I mean, the mortgage. Um, Bank support for borrowers may delay people having to sell houses, but ultimately there'll be people who want to sell their house. There'll be people who need to buy a house, and ultimately they're going to get that done. I would expect that a lot of the listings that are currently not going up will be deferred to future periods.
Alex, how do you think about these two? Are these strong, resilient business for you, or is there more cyclicality here than you think we've seen so far?
Yeah, I think they are resilient businesses, especially REA. The one thing that I'm interested to follow through this cycle is what happens with Domain, because as I understand it, most people see REA Group as sort of the primary place for their property to be listed, and they also get encouraged by the real estate agent to also list it on Domain. But if there's tighter margins, if property prices are a bit soft and there isn't as great a gain when selling the house, do property sellers actually start advertising on one platform for a period? Which Domain would be the main um, player to lose from a situation like that. So that's probably where I'm most interested in following. I think REA is obviously the stronger of the two. It's got higher market share. It gets much more of its traffic from free sources, direct users or organic search. Domain has to work much harder to get both supply and demand, so it's always going to have inferior margins, and I think it's always going to be more cyclical as a result. But I'm really just interested to see if it feels the effects of this to a greater extent, and if REA can actually capitalize on that. Interested to hear your thoughts on that, James.
Well, I think you're exactly right. I think a rising tide, lifts all boats and all that sort of thing. Right now, the tide's going out, and the stronger player is the one that comes through these weaker periods. The weaker periods sort of demonstrate the strengths of the stronger player. In the past, we've sort of argued for a slight premium in Domain's valuations, strangely enough, despite it being the number two, because it has more to gain in terms of yield and maybe margin improvement and that sort of thing. But I think that what we've seen and of course the listing environment was pretty poor for the last 12 months before coronavirus anyway. And so through that and now, we're really seeing the benefits of the higher quality business, I think. And
Has that changed your mind about
that's
Domain, James? Would you, because I know that has, well, ever since Domain listed, that was the view that there was a catch-up opportunity for Domain. Margins could probably rise further than, from a low base than they could for REA, so you'd pay up for that growth. But I struggle to see why you'd buy Domain over REA on any day of the week.
Well, I think it comes down to price, doesn't it? So,
Mm,
look, I think Domain is still a fine business. I think it's not quite as fine a business as REA, and I think that I would therefore pay a little bit more relative to this year's earnings and next year's earnings for REA. But remember that these are both highly priced businesses. They're on
mm.
something like most of 30 times, a bit more than 30 times, I think, 2022 earnings for Domain, which is a really high price.
I know, James. 30 is
And
the new 20.
Yeah, well, maybe, but I think if at the right price, um, Domain is a good business to buy. I think there's also an argument for holding both, because the biggest risk to REA is that Domain eats some of its
Right.
lunch, to coin a
Mm,
phrase.
mm.
And you could remove that risk a bit by having both of them. So I think there's an argument for that. But for me, in terms of relative valuation, I'd pay a little bit more for the REA.
Right. Okay. And just remind us what the recos are on both those stocks.
Oh, well, they're both holds.
Okay. Alex, do you own any of those? Or any interest in one or two of them?
No, I don't own them. I'd be interested in REA. I think it makes sense to buy the market leader here. If you want to hold a business for 20 years, I think I'd buy REA, and I think it should do better over time. Just being the market leader, it should be less cyclical. It should be able to capitalize on its strength, and that should flow into higher margins over time. I mean, I'd consider Domain at a sufficiently low price, but to me, it's not there at the moment.
I should add, by the way, that I do own REA, just as a disclosure,
Yeah.
which I bought last year at around the current buy price. So that sort of hopefully
Mm.
explains why the whole recommendation, as it were. That's what I'm doing.
Yeah, James. While I've got you, I've got a question. Do you think it's complacency from the property vendors' standpoint as to why they actually advertise on both platforms? Are they just encouraged by the real estate agent and they just go along with that? Or do you think they actually get a benefit from advertising on both platforms?
Gosh, that's a good question. I suppose, I mean, look, it is something I've thought about, but I've never really got to an answer. Perhaps what it does is highlight the small cost of advertising on the
Yes.
platforms relative to the overall marketing cost of a house. If you're paying, 30 whatever plus grand to sell your house, a few grand to cover all bases is probably going to be the thing to do, isn't it? So,
Mm.
and the REA and Domain are stronger than one stronger than the other in different sort of regions as well. I suppose in regions, where Domain is weaker, you might not, and that's possibly the point
Mm.
and why it's number two.
Mm.
Um, but if you've got a big, multi-million-dollar home in a big capital city, why wouldn't you? I
So I
think is
sold my house about 2 years ago, or well, maybe 3 years ago actually now, and I asked my agent this exact thing: do I need to advertise on both? And he suggested strongly to do REA and Domain. They cost about 3 grand each to advertise on from memory,
And that
and
cost is
that
all
cost,
passed through to you.
yeah, 100% of that cost is passed on to me. He said you have to do both. He said don't even bother doing. There's a whole plethora of free sites. I don't even know the names of any of them. He said there's about 10, and
well,
he said it's not.
Gumtree would be the obvious one, yeah.
There's a whole lot of specialist ones. I think one's called like Open Door. There's a whole heap of them.
Yeah,
And he
yeah.
said don't even bother with those. It's not necessary. But he said you've got to advertise on both. And I thought that was quite interesting because I was keen not to do Domain. I only want to do REA. But he pointed
But
out
in
exactly
Sydney,
your
you got to
point.
do Domain, yeah. I mean, because it's relatively strong here. So,
Well, I think as if
um,
you're a buyer, you're checking kind of both. But anyway, but he said to me that for if you're buying property in or selling property in Sydney, then what's 3 grand against your property value? So I think that argument gets James, you said it highlights the discrepancy between the cost and the value that these things generate.
mm.
Yeah, got first-hand experience with that. Completely agree.
which is part of the bull case, of course, for both. Yeah.
For
Yes, I
both,
guess so.
yeah.
Yeah,
Because when you think of the agent's incentive as well, they've got an incentive to sell the property quickly, and the fact that
yeah.
you're paying for the advertising costs across
Oh,
both
yeah.
platforms,
Well, they have subscriptions as well, so they pay fees as well, and then there are additional costs for the listings.
Mm.
right? Yeah, yeah. So I guess most people trust their agents and go with both platforms. It helps
Mm.
faster sale for the agent, and that cost is small overall relative to the cost of listing a property.
Interestingly, he also said that he suggested I consider the local paper as well. And I kind of laughed at him, saying, "Why would I do that?" Yeah. And he said, "Well, there's lots of old people where you live, and they probably still use the paper." So I looked into the cost of it. The cost of advertising, just a normal property ad in the local paper, was 5 grand for a normal ad, and
Wow.
the
There
platforms
you
were
go.
3 grand.
There
I
you
just
go.
think that tells you a
That's
lot about
That tells you
pricing
everything
power.
you need
Yeah,
to know, doesn't it, about
yeah.
about old media, really?
But
Yeah.
also, it shows how much potential, how much latent pricing power those platforms still have. I think they could add another zero almost to that, and you'd probably get fewer people advertising, but you wouldn't, you'd still be making good money.
Yeah,
Yeah.
I'm not sure about another zero, but they certainly have the tailwinds that have got them this far are still blowing
Well, to
blowing
add the
strong.
other zero, you'd have to displace the agent.
Yeah,
which
but
is basically the
I'm not
agency.
sure
Yeah.
you'd want to pay that to both of them. But anyway, I think we're getting caught up. Yeah.
So, Alex, just to summarize, you don't hold REA, but you're interested.
Yeah, that's right. Yeah, very interested.
Okay, and JC, it's currently a hold for us and ongoing coverage, so we'll write something in due course.
Yeah. Well, we just wrote something last week, so not too soon,
All right, not
but
too soon.
in due course, yeah.
Okay, on to our final segment, thinking aloud. We're going to make a little amendment for lockdown. Not we've traditionally said, you can talk about anything you want, but I think it's interesting now to introduce recommendations as well. So if you've read something, seen something, or heard something that's worthwhile, I want to hear it. So JC, let's start with you.
Okay, well, I'm going for the herd option. And I should say at
I
the outset,
somehow thought you would, given your
oh,
obsession
well.
with their herd immunity and all.
Oh, jeez. Um, yeah, so look, I'm always cautious about recommending music because
Oh no.
people tend to like what they like and, don't like to be pushed into things. But I've been listening to Edward Elgar's Enigma Variations, which, look, a lot of people listening, I'm sure, are very familiar with them, but they can just switch off and, well, go and listen to that. But for those that are unaware, it's a series of variations on a theme. It starts off with a somewhat melancholic sort of theme, and then responds with reflections, variations on that theme, which Elgar said were, well, he stipulated each of which are his friends. He said which friend, and their sort of reflections on the theme, and they reflect their characters. So it's kind of a sort of series of 14 um, uh, musical portraits, and they're rather beautiful in themselves. But I just thought in the time of lockdown, it was quite interesting. We couldn't have if you can't have your friends at home, you can at least have a few of Elgar's.
Hey JC,
Everyone, sorry, go on.
do you need a written accompaniment to sort of get
Well,
to the
he
portrait?
did wrote, yeah. So some music, they write program notes, they're called, and he did write program notes for this. And so he
Right.
says he lists the initials of each of his friends is the name of each variation.
Hmm.
Although actually the most famous is called Nimrod, so not initials, which is the ninth, which everyone will have heard. I won't hum it for you, but it's absolutely stunning, Nimrod. If all you do is go and listen to that, then you should. It's I should say that the Enigma is also it's called the Enigma because there's a theme, apparently another theme hidden within that which isn't actually played. So the Enigma, the theme is itself a variation on an underlying theme, which is apparently a very famous, sort of well-known tune, and everyone's been arguing ever since it was published in 1890 or something, first, but what that underlying theme might be. Um, I think Rule Britannia is considered a hot favorite, but it's uh, it's just rather beautiful music, and they're just rather amusing portraits. I think you do gain by going online and looking at the program notes to
Hmm.
see what they're trying to, what who he's trying to reflect. His wife's in there, and Nimrod is about his publisher, a guy called Jaeger, which is um, the German for hunter, which is why Nimrod, who was the hunting god or something. Um, anyway, he was very encouraging to him anyway, and
Ha-
when Elgar was very down, he came around and encouraged him to write more and all that, and it's very sort of uplifting piece of music, Nimrod particularly, but the whole variations is a delight. So if anyone wants something to, it's only about 40 minutes.
I was
So
going to ask
there
how
you go.
long. Okay, is that 40 minutes each portrait or 40 minutes
No,
for
no,
the whole
no.
thing?
Each they range from about 30 seconds
Oh,
to
okay, right,
Nimrod's 6 minutes, I think, and then the finale. So actually, it's 13 variations, I think, and then the finale. So the finale is about 6 minutes. Anyway, look, it's extremely jolly. So there you
right. Okay, I did not expect that at all, James. I have to say, nice one.
go.
Well, I've actually been watching something on Netflix I thought was just amazing. I've been watching that Michael Jordan documentary. I think it's called The Last Dance. My wife's a sports fan, which is my life's greatest lament because I've got really nothing to add about sports. But so she's kind of forced me into watching this, and I did it reluctantly until the first 10 minutes. Just completely sucked me in. And I think for people interested in business and investing, there's a lot to like in this series because it documents the rise of the Chicago Bulls. It's not just about one basketball player, it's about an entire franchise and how it was made successful, what it takes to make a sports team successful, all the behind the scenes machinations, all the other elements that have to work to get a very successful and profitable sports franchise up and running, and how that's changed over time. It's fantastic. It's one of the best docos I've seen in a very long time. So I highly recommend it. It's called
What's it called again? Oh, sorry. Yeah.
called the last. It's called The Last Dance,
Right.
and
Sounds.
particularly interesting for people into business and investing. And I have no interest in sport and very little in basketball, but I still am enthralled by this. So yeah, it's on Netflix. I highly recommend it. Alex, you've seen it?
Yeah, I have. I can second that. It's fascinating. It's a
Yeah,
great
thought
watch.
you might have actually.
Yeah. um,
What do you got for us?
I feel like a bit of a boring investment nerd to finish, but I actually last night watched a YouTube series with Chris Judd, the AFL player. I understand. He's got he's got two. One's called Talk Your Book, and one's called Masters of the Market. And he gets on a series of investment guests onto his YouTube channel and talks to them about investing. And the one that I saw last night was with an investment banker by the name of David Williams. You may know him as the founder of Kidder Williams, which is an investment bank here in Australia. He's
Hmm.
someone that I'd actually never come across. And I don't normally watch investment bankers, but he told a fascinating story about medical developments, which I think you wrote up recently, James.
I did. I was a bit negative on it. Did he like it?
Well, he was the investment banker behind its float, and it was a fascinating story. So he actually found the business. It was a private business, and it was making $1 million pre-tax. And he was able to negotiate the purchase of that for $10 million, subject, and this is the key point, subject to due diligence and financing. And so then he went off and talked to all of his fund manager friends and organised an IPO of the business for $16 million. And so he got them to chip in the $10 million, which went to the original vendor of the business, floated the business for $16 million, and he came away with a 38% stake without putting in any money.
Oh my goodness!
And he's done
Right.
that with a handful of deals. I think Tassel, is it the salmon business on the ASX? He also did it with that. So the punchline here is that medical developments is now $750 million business, and he's got a huge stake in that business without having to put in any money. So yeah, pretty.
Nice work. Nice work if you can get it.
Yeah, I mean, if you've got the connections and the know-how to do it, it's a great gig. But pretty
Yeah.
inspiring to watch and to see how other people create wealth, and inspirational in the sense of trying to be creative in how we think about businesses and appreciate opportunities. And if you can bring new thinking to a situation, then perhaps you can do well out of it. So yeah, I thought
Well, he's uncovered some value. I mean, look, you've got to give it, the society needs people who can allocate capital and who can uncover value and make sure that the right companies get the right value. So, hats off to. That's what I say.
I reckon the easiest way to make money is that private public arbitrage. Just finding a private business and taking it public, you get an instant, probably tripling of the value of that business. I've
Geez,
seen.
what are we all doing, guys? Come on, let's. I've got an idea. Let's have a Zoom meeting after the call.
yeah, I wouldn't describe it as easy. Maybe it's simple, but it's not easy.
Well, it's easy in that you don't have to do much. You don't have to change the business and find new customers and add revenue or anything like that. It's an instant valuation
Well, you've got to
uplift.
be able to isolate value, and you've got to be able to convince
You
other
got to be able
people
to convince others to, yeah, yeah.
So you got to have the people. People have got to have the faith in you and your. Look. I mean, there are various things you've got to be able to do. So
But you see this actually, if you want to, I think that there's a whole segment of the ASX that does essentially that. It's that roll up segment. So I've been scathing of G8 education for years about that. All that business is it's set up to take advantage of public-private arbitrage. It buys private businesses on 2 or 3 times EBITDA and it rolls them up and it gets them valued on public markets at sort of 10, 12 times EBITDA. And that's the entire business model. There's no synergies. There's no brand to build. There's no shared, there's a head office cost, and that's about it. And there's a whole segment of the ASX that just does that. Bankers have a very specific task. So this criticism is not really for bankers. But if you're an ASX listed business and all you're doing is public-private arbitrage, I don't really want any part of
Well,
that.
you're sort of creating economies of scale in a business. You're sort of
Are you?
creating, I suppose.
I think you're being very generous.
You're putting things together, consolidating an industry, making the economy more efficient. I mean, I think there's.
Well, I don't think there will be any points for
I'm trying to be
consolidation
kind.
for certain steps. Yeah, I think you're being very generous. Yeah, for me, it's
what I want to
people
know.
who've figured out how to game something and are fooling others into
Tell
following
us again, Alex, how we find this podcast.
Oh yeah. Is it a podcast or is it a YouTube channel? Is it?
Yeah, it's YouTube.
Oh, what was it?
YouTube.
Oh, it's YouTube.
Yep. So just look up Talk Ya Book or Masters of the Market.
Oh, okay,
Yep.
right. And it's Williams, David Williams. Do you say?
David Williams. Yep.
Yeah, right. Great.
Interesting. Nice one, Alex. That's good. All right. Okay. Well, let's leave it there, gents. Thanks very much for your time today, Alex. Good to have you on, and we'll have you on again.
Yeah. Thanks, guys. Great to chat.
Yeah.
And JC, as always, thanks for your time today.
As always, cheers.
Everyone else, thank you for listening.